You just found the video that answers the question every financial system in America assumes you already know the answer to. If you've ever tried to get approved for something, a credit card, an apartment, a car loan, and been told you don't have enough credit history, while simultaneously being unable to build credit history without getting approved for something first, you already know exactly how broken this feels. You need credit to get credit, and nobody tells you how to break into that loop. That feeling has a name. It's called the credit catch-22, and it stops millions of Americans every single year. Immigrants, young adults, people recovering from financial hardship, people who simply grew up in the households that use cash for everything, from accessing the financial system that everything else in this country runs on. Most people think building credit from scratch means waiting, being patient, maybe becoming an authorized user on a family member's card and hoping for the best, and then crossing your fingers that somehow, eventually, a score appears and doors start opening. But here's the contrarian truth. Building credit from scratch in America is not a waiting game. It's a sequencing game. The people who build strong credit fast from zero aren't luckier than you. They didn't have better family connections or more money. They just knew which moves to make first and in what order. And that sequence, done correctly, can take someone from invisible to the credit system to a score above 700 in under 12 months. I've researched every legitimate path into the American credit system, the ones that actually work, the ones that are slower than advertised, and the ones that sound good but quietly waste your time. And what I found is that there are 5 moves that matter. 5 specific steps that build on each other in a specific order. Get the order right and the system works for you. Get it wrong and you spend years spinning your wheels wondering why your score won't move. Here's the plan. We're going to start with the fastest legitimate entry point into the credit system that almost nobody uses correctly. Then we're going to cover the move that adds the second most important dimension to your credit profile in the shortest amount of time. After that, the strategy that accelerates your score by leveraging someone else's credit history without putting them at any real risk. Then the tool that most people don't realize is already building or destroying their credit right now. And we'll close with the exact timeline in month by month of what to expect when you do all of this right. Let's start with the fastest legitimate entry point into the American credit system. And that's a secured credit card from a major issuer that reports to all 3 bureaus. A secured credit card works exactly like a regular credit card in every way that matters to your credit score. You make purchases, you receive a monthly statement, you make a payment, and that entire activity gets reported to Equifax, Experian, and TransUnion every single month. The only difference between a secured card and a regular credit card is that you provide a refundable cash deposit up front, usually between $200 and $500. That becomes your credit limit. The deposit protects the bank. The card builds your credit. That's the trade. But here's where most people make their first mistake with secured cards. They walk into a random bank or find a card through a predatory issuer and end up with a secured card that charges an annual fee, a monthly maintenance fee, a processing fee, and sometimes even a fee just to apply. By the time you add it all up, you're paying $75 to $150 a year to build credit on a card with a $200 limit. That's not a tool. That's a trap dressed up as an opportunity. The cards you want are from issuers like Discover, Capital One, and major credit unions. The Discover it's secured has no annual fee, reports to all 3 bureaus, earns you actual cashback rewards while you build credit, and reviews your account starting at 7 months for an upgrade to an unsecured card and return of your deposit. The Capital One Platinum Secured works similarly and has one of the most flexible deposit structures in the market. You can sometimes get a $200 credit limit with as little as a $49 deposit depending on your application. Here's how to use a secured card to build credit as fast as possible. Use it for 1 or 2 small recurring purchases every month. A streaming subscription, a gas fill-up, a grocery run. Keep your balance below 10% of your limit on the statement closing date. Not the due date, the closing date, because that's what gets reported. Pay the full balance every month before the due date. Set autopay the day the card arrives so you never miss a payment accidentally. That's the entire system. What you're building here is twofold. First, you're establishing payment history, which is 35% of your FICO score and the single most important factor. Every on-time payment is a data point telling the bureaus you're reliable. Second, You're establishing that a revolving credit account exists in your name, which is necessary before your score can even be calculated. Most scoring models require at least one account that's been open for 6 months before they'll generate a score at all. So the secured card isn't just your first step, it's the key that lets you into the building. Everything else we're about to talk about builds on top of it. But a credit card alone only covers one type of credit, revolving credit, and the scoring system rewards people who can handle more than one. That's where this next move comes in, the move that adds the second most important dimension to your credit profile. Faster than almost any other method is a credit builder loan. A credit builder loan is a financial product specifically designed for people building credit from scratch. Here's how it works. You apply for a small loan in typically between $300 and $1,000 from a credit union, a community bank, or an app like Self or Credit Strong. But unlike a regular loan, you don't receive the money up front. Instead, the lender holds the funds in a locked savings account while you make fixed monthly payments over a term of 6 to 24 months. At the end of the term, the account unlocks and you receive the full amount you paid in minus a small amount of interest. Every single payment you made along the way gets reported to all 3 credit bureaus as an installment loan payment. Here's why this matters so much for your credit profile. Your credit score is built from 5 factors, and 2 of the biggest ones, payment history at 35% and credit mix at 10%, are both served by a credit builder loan simultaneously. Payment history, because every monthly payment is a reported on-time payment. Credit mix, because an installment loan is a completely different category from a revolving credit card, and the scoring models reward people who demonstrate they can handle both responsibly. People who have only a credit card have revolving credit. People who have only a loan have installment credit. People who have both are telling the system, I can manage different types of financial obligations. And the system responds by building their score faster. In real numbers, the Self-Credit Builder account, one of the most accessible options, lets you choose a monthly payment as low as $25. Over 24 months, you'll have made $600 in payments, received most of that back in savings at the end, and generated 24 months of positive installment loan history across all 3 bureaus. The cost is the interest, typically $89 to $150 over the full term depending on the plan. That's less than $7 a month to add an entirely new credit dimension to your profile, while simultaneously saving money. The combination of a secured card and a credit builder loan running simultaneously is the core of every fast credit building strategy that actually works. They cover different scoring categories, they both report monthly, and they compound each other's impact. Together, they can generate a scoreable credit profile in 6 months and push that score above 680 in 9 to 12 months for someone starting from zero. Now, both of those methods build credit using your own accounts and your own money. But there's a third method that lets you borrow someone else's credit history. And done right, it costs them nothing and accelerates your score significantly. The strategy that leverages someone else's credit history without putting them at meaningful risk is becoming an authorized user on a trusted person's credit card account. Here's how it works. Someone you trust, a parent, a spouse, a close family member, adds you as an authorized user on one of their existing credit card accounts. That account's entire history, its age, its payment record, its credit limit, its utilization, gets added to your credit report as if it were partially yours. You don't even need to use the card. You don't need to have the physical card in your possession. Simply being listed as an authorized user on the account is enough for it to appear on your report and factor into your score. The impact can be dramatic when the account is the right one. The ideal account to be added to is old, the older the better, because length of credit history is 15% of your score. It should have a perfect or near perfect payment record, and it should have a low utilization rate, near meaning the primary cardholder isn't maxing it out every month. An account that's 8 years old, never missed a payment, and runs at 5% utilization. Added to your thin credit file can move your score by 50 to 100 points in a single reporting cycle. The reason this doesn't put the primary cardholder at meaningful risk is that authorized users cannot take on new debt in the primary holder's name. They can't change account terms, request credit limit increases, or access the account online in ways that could cause damage. The primary cardholder retains full control and can remove the authorized user at any time with a single phone call. The conversation to have with a family member is simple and honest. You're not asking them to co-sign a loan. You're not asking them to take on any liability. You're asking them to add your name to an account they're already managing responsibly, so that account's history can appear on your credit report and accelerate your score. If they're concerned, they don't even need to give you the physical card. And here's the important distinction. This strategy works best as an accelerant, something you add on top of your own secured card and credit builder loan, not instead of them. Because eventually you'll be removed as an authorized user, or the primary cardholder will close the account. And when that happens, you need your own independent credit history to stand on. The authorized user strategy buys you time and boosts your early numbers. Your own accounts are what sustain the score long term. Now, there's a fourth method most people don't even realize is already affecting them right now. And depending on what you do with it, it's either quietly building your credit or doing absolutely nothing when it should be doing everything. The tool that most people don't realize is already building or destroying their credit is rent and utility reporting. And the way you use it changes everything. Rent is typically the largest monthly payment most Americans make. For someone building credit from scratch, paying $900, $1,200, or $1,500 in rent every month on time is an enormous demonstration of financial reliability. And for decades, that demonstration meant nothing to the credit bureaus. Rent payments weren't reported. They didn't show up on your credit report. You could pay rent perfectly for 5 years and have zero credit to show for it. That's changed. Experian, TransUnion, and Equifax now all have mechanisms to include rental payment data in credit files, but only when it's reported, and it's not automatic. You have to set it up. Services like Experian Rent Bureau, Rental Karma, and Level Credit allow you to report your rent payments to one or more of the bureaus. Some property management companies and landlords already report through these services. If yours doesn't, you can enroll directly through the service yourself, often for a small monthly fee between $7 and $10. And your rent payments start appearing on your credit report as positive payment history going forward. Some services can even report up to 24 months of past rent history if you can provide documentation, which means you could add 2 years of positive payment history to your report in a single enrollment. Similarly, Experian Boost is a free tool that lets you connect your bank account and add utility payments, electricity, water, gas, and even subscription payments like Netflix and Spotify to your Experian credit file. The average Experian Boost user sees an immediate score increase of around 13 points just from adding this payment history. It takes about 5 minutes to set up and costs nothing. For someone building from scratch, these tools are not optional extras. They are the difference between a thin credit file with 2 accounts and a robust file that shows a comprehensive pattern of financial responsibility across rent, utilities, and credit accounts simultaneously. The bureaus respond to that comprehensive picture with higher scores and faster approval pathways. Now, let's put all of this together. The question everyone asks is, how long does this actually take? Here's the honest, realistic timeline when you execute all 4 strategies correctly and simultaneously. Month 1 through month 2. You open your secured credit card and your credit builder loan in the same week if possible. You become an authorized user on a trusted family member's account. You enroll in Experian Boost and a rent reporting service. At this stage, your score may not exist yet. Most models need at least 1 account open for 6 months, but you've planted every seed. Month 3 through month 6. Your accounts are reporting. Your score becomes calculable for the first time. Depending on the authorized user account added to your file, you may see an initial score anywhere from 620 to 680 generated at the 6-month mark. You continue paying everything on time. You keep your credit card utilization below 10% on the closing date every month. Month 7 through month 9. Discover reviews your secured card for an upgrade. Your credit builder loan is halfway through its term. Your score is climbing, likely in the 670 to 710 range for someone who has done everything correctly. You start becoming eligible for entry-level unsecured credit cards with actual rewards. Month 10 through month 12. Your score crosses 700. Some people following this system hit 720 or higher by the 12-month mark. You now have a payment history, a credit mix, an established account age, and a growing profile of positive data across all 3 bureaus. The financial system that felt completely closed to you 12 months ago is now beginning to open. This is not theory. This is the actual mechanics of how the American credit scoring system works, applied in the right sequence, at the right time. If this video helped you, hit the like button. It genuinely helps this channel reach more people, and it takes you 1 second. Subscribe if you want the follow-up video I'm dropping next week. It covers the exact step-by-step redemption strategy to get the most value out of every point you've already earned. You've done the hard part. That video will show you how to cash it all in. I'll see you there.